Good afternoon, ladies and gentlemen, and welcome to the HEADLAM Group PLC AGM trading update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to Chief Executive Chris Payne. Good afternoon, sir.
Afternoon, everybody. Thanks for joining the presentation. So I'm Chris Payne. I'm going to take 20 minutes or so, maybe half an hour, just turn in some slides to give you an update since the last time that we had the opportunity to present on this format. So if just turning over the page, a brief agenda. So a little bit about us. As I said, I'll try and canter through some of these things for many of you may have seen us before. I'll do a quick summary of the results of 2021, which may seem a little bit old news now, but as I said, we haven't had the opportunity to present on this format since we closed out the year end. A reminder about how we look to allocate our capital, and then perhaps a little bit more detail around the strategy as we see it and the status of how we're implementing that. And one perhaps towards the end then we'll just summarise with a trading update for this year. Some of you may have seen the RNS that we put out this morning, just outlining the trading update ahead of the AGM today. So we'll just summarise on that, and then we'll perhaps take questions at the end. So just about HEADLAM. This is just a one-pager that we typically put together, just summarising some of the key attributes of the business. We've been operating in our current format for over 30 years. We've got a large number of relatively small customers, predominantly in the independent retail sector on the high street, and those businesses that operate without premises. We have a very wide, comprehensive offering, probably the largest in the industry of stock holding across the UK predominantly, which we serve both the residential market through, as I said, the high street retailer and local fitters, but also the commercial sector, which typically would be whether it's schools or offices or doctor surgeries and the like. And we have a very deep stock holding, as I mentioned earlier, so 39,000 SKUs, which is stored in a number of warehouses across the UK. So we are pretty much across the whole country. We've got 66 businesses, and when we say businesses, what we mean is independent, largely B2B distribution businesses with their own sales teams selling into their local markets. We do that through 21 distribution centres and sort of on a hub and spoke type model. And also through trade counters. We'll come back to trade counters a bit later, but those are trade-only trade counters where customers can click and collect orders and buy some incidentals like underlay or screeds and the like to go with their floor coverings. The business has got a strong foundation, so it's got a good balance sheet. We typically do turn our profit into cash, and we've got a very strong, well-run team, balance sheet. And we have got we're building an increasingly strong track record of delivering positive change that has good results on the bottom line and indeed on balance sheet improvements. Just a couple of points at the bottom of this slide. We'll be talking about growth opportunities, and I think this is a slight change in emphasis in the last year or two, where we've moved away from predominantly talking about sort of self-help measures, if you like, on cost reductions and efficiencies, and moving slightly into a more expansive part of our strategic growth story, which turns our business into more of an expansive proposition to take more market share. And I'll come on to that and explain what that means in a little bit more detail when I get to the strategy slides later in the deck. So just before we get into the financials, just a brief update here on the board and the shape of the board. And this has changed in recent times, and indeed it's changed since I last spoke on this platform. So my role has now been made permanent. So when I spoke to you previously, I was the interim chief executive whilst combining that with my CFO role. So that's now been confirmed as a permanent appointment, which of course I'm delighted about. So validation of what I was doing and what I was delivering into the market. So that's great. I'm now busy building a team around me. So I've appointed an interim CFO, Patrick Butcher, who's joined on a temporary basis until I've found a permanent replacement, and he's got a wealth of experience from a number of PLCs, and that's a great addition to provide me with some support in the short term. Around me now, I've got a new chairman to work with. So Keith Edelman, who was previously a non-executive, has now taken over from Philip Lawrence, who stood down today. And Keith has now taken up the role of chair following the AGM earlier today. He's, again, a wealth of experience in a number of PLCs and currently sits on a number of boards. And then my fellow non-execs, sitting around the board table, we've got Stephen, Simon and Amanda have been with us for a range of periods, but Simon and Stephen relatively new to the business and bring with them a good deal of sort of commercial insight, which has been extremely helpful to me as I've built the growth strategy that I referred to earlier. So very relevant experience, in particular Simon's sort of experience at TP and also at Wix have been really helpful as we've started to roll out the trade counter footprint that we'll come on to talk about later. So I think we'll also look to perhaps add another non-exec later in the year, and there'll be more information on that in due course. So as promised, I'm just going to give a quick summary of the financials for 2021. Obviously, I won't spend too long on this, given it's a number of months ago, but I'll just pick out some of the highlights and some of the key slides from the presentation that's been available on our website for some time. So just sort of focusing, I suppose, on the recovery we saw in 2021. And I mentioned earlier that our business serves both the residential market and also the commercial sector. So the market is predominantly broadly 2/3, 1/3, 2/3 residential product, 1/3 commercial product, and that's reflected in our split of our revenue, which you can see in the chart on the right hand side. And that's been moving a little bit in the last couple of years, and perhaps coming back the other way at the moment. But over the last couple of years, certainly through the COVID affected periods of 2020 and 2021, we saw residential strengthen, and many businesses facing into the domestic market would have seen something similar. So people, homeowners investing in their homes, replacing flooring. Certainly we were the beneficiaries of that. And it meant that the business shape moved slightly towards residential. And certainly in the commercial sector, then there was a period where some of the spend in the commercial sector perhaps wasn't spent on refurbishing the floors of pubs, hospitality, and the education sector was spending their budgets on COVID protection rather than on replacing flooring in those spaces. So a slight shift and a softening in the marketplace in the commercial sector, a strengthening in the residential sector. So what did that mean for our numbers? So on the left-hand side, we could see a strong rebound in total revenue in 2021 from 2020. And obviously we had quite a significant decrease in revenue during 2020, which we'll come on to show what that means on the next slide. But that did come back quite strongly in 21, and also it had an impact on margins. And typically our margins in the residential space are slightly higher than they would be in the commercial sector, simply because the size of each transaction is relatively small. They typically would be a single room in a home, for example, and because of the size of that particular transaction, it's quite a small transaction that's delivered individually, the margins in that area are slightly richer than they are in the commercial space, which might be a much larger 5, 6, 10 times the scale of order size with one delivery. So slightly different dynamics, but it did lead to a slightly better gross margin performance in 2021 than we've seen in recent years. Underlying operating margins are improving, and we're well on the way to achieving our target 7.5% operating margin that we've stated in the past and we've stuck to. So there's some great benefits coming through from the cost saving initiatives that I referred to earlier. And now we're moving into more of a market share and targeted a growth aspiration for our strategy, which will deliver the lion's share of the balance of the operating margin improvement. So we saw that bounce back in underlying PBT from a relatively modest position in 2020 back to a sort of more normalised level in 21. And I mentioned the strong balance sheet, and I think that's something that we've continued to deliver on in recent times, and we were able to close the year out in a strong net funds position. and in particular a very strong average position. And again, in our normal slides at the year end, we publish our net funds sheet, which shows the monthly profile of how we see our funds moving throughout the year. And that's a really useful slide to show how, I suppose, cash generative we've been over recent time. So we were able then, as a result of that strong cash performance, to announce a final ordinary dividend, and indeed, following the confirmation of our capital allocation, a strong special dividend, and in combination with the buyback program. So a strong kind of message around a capital return to shareholders, which look to serve both an income through the normal dividend, a special dividend, and indeed a buyback program. So a little bit for everybody, I suppose, but just to demonstrate the strength of the balance sheet. So the next slide, this is really demonstrating that kind of big dip, the V-shape revenue profile that we saw during 2020, and then that recovery back in 2021, which is a pretty strong bounce back. We're not alone in that space, where lots of residential facing businesses did see a similar sort of pattern. And I suppose one of the remarkable things about this slide, and we do tend to publish this on an annual basis, is relatively close proximity of each of the lines to show that typically the business performs in a similar sort of shape year on year. 21 slightly different because we had a soft start, which then caught up in Q2 because of the COVID affected early period. But as a whole, 2021 was a relatively sort of normalized level of trading, if you like, albeit affected by other things in the marketplace. So this is a slide that we like to repeat. It's a good, consistent slide for us to show where the various points of activity are in the year. And in particular, I might draw your attention to the July-August time, where the orange line that you see for 21 and indeed the grey line for 20 were suppressed, which reflects the fact that the commercial spend has been subdued in the last couple of years. And I'll come on to that in the outlook when I cover the 2022 trading. So this is a slide that we will refer to in future presentations as well. So just a handful of sort of track record points here, which demonstrates that move back towards a stronger revenue return, and just compares across a couple of years rather than just a reference against prior year. So you can see 2019 as a reference on this slide, which has been a useful benchmark for us, so because it does normalise a little bit out of the effect of COVID in 2020. So we can see a more consistent look through against performance from the sort of pre-COVID event. So we're looking for the business to move back to the levels that we saw in 2019, and certainly profit moving back in levels that we saw prior to the pandemic. So just moving on to the capital allocation priorities, as a reminder, I mentioned during the review of the financials for 2021 that we saw a strong end to the year, strong cash performance, and we had sort of signalled early on that we would look at how we could return surplus capital and surplus cash to shareholders. And that was based around these capital allocation priorities that we published for the first time in 2020. So this is effectively a step through, and it works from the top and moves down the page on the left-hand side. So on the left-hand side are the priorities we've published. On the right-hand side is what we've seen in recent times, and therefore our ability to announce a capital return. So maintaining a strong balance sheet, that's a given for us. That's something that we focused on and remains true today. So that's certainly in place, and we're not looking to change that. Investment in the business, we are looking to invest further funds and capital in things like the trade counter rollout. And again, I said I'll come back to that, and I will, but we're looking to increase those 54 trade counters that I referenced at the start up to 90 and above in the next couple of years. And we've indicated that may take something like 18 to 20 million pounds worth of capital to do. And therefore we are investing in that now. We're seeing a material impact on those sites that have been improved, and therefore it's given us the confidence to try and accelerate that. We've also looked to invest in upgrading some of our material handling equipment. I think that's been an area we've underinvested in the past. So, you know, having aged forklift trucks, having old equipment that's as part and parcel of your infrastructure doesn't make sense. So we are looking to accelerate some of the replacement cycles of that equipment. And then, of course, once we've done that investment, and it's a relatively light amount of capital that we need to do that, then we can start to look at making distributions, looking at acquisitions. So we've announced our sort of twice covered dividend, ordinary dividend. So we're able to get back on the shareholder register and distribute for that. M&A, nothing in the first half, nothing we looked at it towards the end of last year either, but there may well be things that we wish to do later this year or beyond. So it doesn't make sense to necessarily completely disperse all of the capital that we see in the business right now, and it's good to have a bit of flexibility for the future. But despite all of those things, we were left with an amount of surplus capital that we were able to return. We did have in the past a discussion with certain shareholders about preferences on buybacks and specials and various other things. So it made sense to me, and it made sense to the board that we should do a bit of both, offer a special dividend for those who expressed a preference in dividend income, and also then go through a structured buyback program where we could buy a certain amount of liquidity that we have in the marketplace, which we indicated may take, say, 12 months to do. So that was announced in March, and we're well on the way with doing that. So just turning to the strategy that we've talked to in the past, and really just to provide a bit of a roll forward on where we've got to, and how we've been structuring the operations accordingly. This slide is really the sort of main slide, I would say, which summarises my thoughts on how the strategy looks and where we're pressing ahead with trying to grow market share. So we took a bit of time to understand the scale and size of the marketplace in the UK, and look at where money is spent across the market, and also where we participate as a business. And what we're able to do, and again, I've talked about this a couple of times, is segment the market into different customer types. And of course, there are micro versions of this that would break down these sections into even finer detail. But these sort of main 7 customer types, and we were able to red, amber, green our presence in those markets. So on the left-hand side, traditional retailers that I mentioned at the start, the high street, the independent fitters, we have a relatively high share, and we've been operating in that market for some time. But as you move to the right on this slide, there are other types of customer, other segments where perhaps we've got less share, less investment, less history, and therefore there are parts of the market where we're underweight. And therefore that presents an opportunity for us to develop propositions, start to engage the marketplace in a different way, and really go after some growth, to counterweight really the kind of lack of growth that you might feel in sort of GDP and some of the challenges we're seeing in the residential sector that I referred to earlier. So it's a clear and obvious strategy for us to move into those areas. We've got credibility, we've got scale, and we've been building those propositions to take advantage of those other customer types. This is the next slide is really a conversion of that logic and thought process into the building blocks of what we've been doing. So the 4 blocks at the top are really kind of internal measures, things that we've been doing internally, if you like, around operating efficiency, developing our products, developing our brands, building our relationships with suppliers, looking at our ESG strategy, which I'll come on to in a bit more detail in a moment. But those are sort of internal measures. And then the bottom 3 boxes is how we're presenting ourselves to the marketplace. So I mentioned the trade counter rollout. We've accelerated that rollout. We're moving from 53 up towards 100 in the next couple of years. And only today I signed 3 more leases for new sites. So we are well on the way, and looking to build that with a real pace in the next couple of years. Multiple retailers I've talked about in the past, and we've shared some slides in the past about some of the penetration we've had in that space of developing new relationships, leveraging off some of the case studies that we have in the marketplace. And we think that's quite a big chunk of the market. We think that's £1 billion worth of sales for us to go out there, and we've got relatively low share, and therefore presents a great opportunity for growth. And that can only really be done with an improvement in our digital offer. So the multiple retailers and the other types of customers in that space, and on the right-hand side of that chart, have got a different level of expectation and service requirement about the digital and e-commerce connections. So developing online ordering techniques for those large customers rather than on the telephone, which our traditional customers might choose to use, is fundamental to us being successful in that space. And we targeted 30% of our sales through the digital channel, which is quite ambitious, and it certainly seemed ambitious when we said it, but we're up to 25% now already, off a relatively low base in 2019. So more than doubled our online orders in the last couple of years, and there's more to go. So it's been pleasing kind of to see that level of growth in the online ordering, but I think that's, as I said, there's still more to come there as we develop that capability further. So just a little bit more detail on trade counters, and some of you may have seen this before, but there's a picture of this sort of new format on that slide there. So as I said, we're accelerating this. We've got a blueprint. We know where we're going. We've got the list of the locations that we'd like to target and move into, and we've been busy securing sites and carrying out building works on those sites to get us ready. I think it's also important to say this isn't just about new sites. We're going to completely refurbish all of our existing facilities and existing sites, and that's all part of that 18 to 20 million pounds worth of capital spend that I mentioned. And where we have refurbished sites, we have seen a significant uplift in performance. And that's something that we mentioned in the RNS. So we're seeing good double-digit growth in sites that have been redeveloped and re-imaged with the blueprint. So we've got that confidence that the benefits we had predicted would be there are coming through now in the numbers. So it gives us that confidence to go harder and faster, and we've been investing in the capability that we need to develop that rollout and to manage the sites once they're up and running. So I think that's an important growth. It's something tangible, it's something that we can see, and we've got pockets of the country where we're underrepresented. So by simply growing new sites in new locations, we will grow share, grow revenue, and by investing in the existing sites, we should improve the quality of the service and improve the quality of the revenue in those sites as well. I mentioned the multiple retailers earlier, and this is a slide that we shared at the year end. So one of our new customers, Oak Furnitureland, this is about us kind of just helping their customer experience in their stores. Clearly they sell oak furniture as their predominant category. They've moved into soft furnishings. They've now moved into flooring with us. And we provide all of their oak flooring for them, fitting out the sort of flagship stores in their estate, and aspirations of rolling that out across the rest of their UK footprint. So, you know, we're going to have to help them with that. We're going to have to help them with the skills they need to sell flooring. They look great, they look amazing, and I think this sort of halo effect that they get on the rest of their product sales has been really great for them. And you know, when their product is sat on a good quality wooden floor, they've ended up selling more of those sofas and the like, and their cabinetry. So, you know, a good effect on the halo, and we're working with them to look at how we can get those into the rest of the estate. My HEADLAM app, this is something that we talked about in the past. It's now up and running, fully rolled out to all of our customers. It gives our customers a real sense of an enhanced experience. You know, they can place their orders, they can search for stock, they can compare pricing and availability across all of their HEADLAM accounts that they may have. And of course, they may have several different accounts with different parts of our business across the UK, and it gives them real-time availability and ordering and placing, making payments. So a bit of a step change for us, and a bit of a step change for the customers. It's something that we're looking to roll out and improve, and we've got the sort of version 1s now live, and we're looking at enhancements. Customer feedback's been really positive. Sales, a couple of million, relatively modest, but it's early days, and it's something that we're just going to build on. So it's all part of that I suppose transformation of the digital and e-commerce route, you know, part of that growth from 11, 12, 13% of our sales coming through that channel a couple of years ago, up to 25% and now beyond right now. So it's an important step, and we'll continue this development as we go forward. You know, the next things that will come out on this is an enhanced visualizer, so customers can see their rooms with their flooring in. And so this is just part and parcel of developing the e-commerce offer for customers as we go forward. I think brands are important in today's market. Consumers really do associate with brands, and we've been spending a bit of time thinking about our product brands. This isn't a distribution brand; these are around product brands and how they're recognised by customers, and what do the brands stand for? What are the product qualities that are associated with these brands, and how can we push the recognition stronger into the marketplace so that our customers, consumers, if you like, are almost specifying these brands. I want that particular product in my flooring, and they look for stockists to carry out the transaction. Something that we think is important typically is a secure sale, higher margin, higher price points, and we're able to develop our own products, our own mixes, if you like, of this sort of wool Britannia product that I've called out on this slide. Is our own blend using a sustainable raw material in wool, and something that we can be proud of and put into the marketplace and consumers can associate with. So this is important that we start to take this position in the market. We have a really tight range, and we know what our brands stand for, and we're looking to do more of this. So I think this is something that we're going to do more of. It's something that consumers can associate with, and we are looking to launch sort of more entry level price points to go along with these premium brands, and that's something that we'll be able to provide a bit more update on, I imagine, at the half year. Just around suppliers, a little bit around suppliers and buying. I spent a bit of time with our suppliers in Belgium last week, and I'm in Holland next week, talking to some of our suppliers around sort of new products that are coming to market. How do we start to develop more sustainable ranges? And the great thing about that is that there's more and more sustainable products coming to market that we can push into the UK. And we are looking to develop our conversations with those partners so that we can create more long-term relationships, perhaps even work with slightly less suppliers than we do today, so that we've got good quality, deep relationships with those suppliers, so that at times of difficult supply, like we've seen in recent times, inflationary environment, the difficulties of getting raw materials, we're the ones who can get supply when we need it. And that's been a real positive thing over the last year. We talked about having strong inventory levels, and I think I've seen a question come in earlier around supply chain issues, which I'll perhaps come on to in a moment. But I think having deep stock holdings and being well represented with all of those suppliers is really important for us, so that we don't disappoint customers when they do have a sale and they wish to place an order. We've got that inventory, it's there, it's available, they don't have to wait 6 weeks for it to arrive, and I think that's been important in today's market. And we've certainly seen an improvement and really good response from our customers about stock availability, and I think that's great for now, and is great for the future. As I said, we're looking to build these strategic relationships. We're having a supply conference later in the year, first time that we've done that. So it's important that we're seen engaging with suppliers, and it's great that we're seen as a valuable partner in the UK. I said about the ESG update. We have now harmonised the ESG update in the report in line with our annual reporting account, so they're becoming one effectively, and ESG will become part and parcel of our business strategy going forward. And I spent a bit of time in the last year-end presentation sort of labouring the point that E, S and G are separate points, not all about sort of this homogenous sustainability. So we are moving along with all of those three parts of that. Now, the G part, we've always been a well-governed business, and we remain committed to that part of it. But I think the E and the S is probably where most people think about ESG. So we've made some statements, we've taken some actions. We are looking at moving to a sort of net zero carbon ambition over the next decade or so. So we are taking actions now. We're filling that plan up with all of the steps that we can take, both now and in the medium term. Around the S, we've talked to our colleagues around this sort of community support, and I think it's important that we represent our community and we act in that sort of a holistic way with our local businesses. So be announcing to our colleagues in the businesses very shortly what we're going to do and how we're going to wrap that up into a sort of community giving scheme, and that's something that we're planning for the second half. As I said, on the other sort of more tangible actions around commercial vehicles, we're moving all of our vehicle fleet, the company cars, to low emission vehicles, and that's all in place. And we've set ourselves a target of having half of our company car fleet as being low emission vehicles by the end of the year, and we're well on track for that. And again, I mentioned these sort of sustainable products that the suppliers are launching. It's important that we play our part in that, identifying which of the products that make sense in the UK, how we can promote them, how we can get behind them, and how we can play our role in the distribution cycle for those products. So I think that's something that's just going to get more and more momentum, something that we are passionate about, and no doubt our customers will increasingly be so as well. And certainly if we're moving into more of the multiple retailers and some of those other customer segments that I mentioned earlier, this is a hygiene factor. We need to be focused on this. We need to be able to demonstrate our credentials in this space to be a credible supplier in those customer types. So something that we're going to continue to focus on and provide regular updates on in the half year and the full year results. So just turning to the trading update, we put a trading update out this morning, and I've just pulled out a few bullet points here, which probably is the real meat and drink of this update. We are seeing revenue starting to soften a little bit, but we're still in line with the revenue that we saw in 2021. And I mentioned this sort of residential commercial split that we saw moving towards residential during the COVID affected periods of 2020 and 21. We're actually seeing that reverse now, and I think that's consistent with a lot of other businesses that face into the home and the residential space. So we are seeing the residential market starting to soften, and that's not surprising given what's happening with consumer sentiment and footfall and the inflationary pressures that people are under, both in terms of heat, light and power costs, but also the ability to go and spend money on other things like holidays and hospitality. But on the flip side, the commercial market is coming back a little bit, and we're seeing some good bounce back on commercial spend, and I think the anticipation and whether it's hope or expectation, there seems to be an expectation that there will be that recovery in the summer period where education will now need to replace those floors they perhaps deferred in the last couple of years. And I think the expectation is there will be a slightly stronger commercial market in the second half than we've seen in the last couple of years, and that's been borne out in our figures in the first 4 months. Amongst that sort of overview, if you like, there are some points of detail worth calling out. So those branded products that I mentioned earlier, where we've tightened what the products mean, what they stand for in the marketplace, they've done better than the average blend. The trade counters that we've refurbished have done better than the average blend. And we refer to delayed orders on here. There was one of our large customers had some system glitches, which meant that they weren't able to order products in April, and those have started to come through in May. So there's little bits of detail here and there which has affected some of the trading patterns. But generally speaking, the revenue has been a little soft, broadly in line, but the margins have been strong. They've remained strong. The performance that we saw at the end of 2021 has continued into 22. The operational efficiency measures that we took last year have carried on their sort of full year effect, if you like, into 2022, which means we're in a reasonable place on profit despite the slight sort of softness on revenue that we started to see. So that's it in a picture. I think on the strategic developments, just to roll those forward, we have sort of continued the growth of new customers on the multiple retailer sector. The proposition work that we did has landed well, and we've started now to see some services into those customers, and those will largely be seen in the second half. The digital channel that I mentioned is up to 25%. That's a high point now, and we're expecting that to continue to increase. I've mentioned the trade counters have continued at pace, and as I said, I'm signing more sites off today, even. But so more and more sites will be coming on stream later this year. So I think that it then comes to the outlook and how do we see that. Who knows how the year is going to shape out, but I expect this residential softness will likely to continue given all the cost pressures we just talked to. We're expecting that commercial market to come back a bit, and I think these strategic countermeasures, these large multiple retailers that I've said are signing up, we'll see that as new revenue streams in the second half, perhaps, that can combat some of the softness. But who knows what the year is going to bring out, and I think a note of caution perhaps there. But everything we've got in play is delivering. And we'll hope that that continues. And the education sector that we refer to, let's hope that that does also come back in the summer months. So just sort of final slide from me, really, just a summary, sort of closing commentary. I suppose we remain committed to our growth strategy. The early signs are good that we're delivering on the trade counters, delivering on the new customer types, and that will mitigate, no doubt, that some of the weakness that we've seen in the core markets and certainly in the consumer sentiment and the residential sector. Profits are hanging in there. You know, we've still got some good margins there. The cost effects that we've taken out at the end of 21 are still helping us in 22. So we can still see a clear path to the expectations that are in the market for 2022. And we've got you know, a new board, a growing team. I'm still searching for a CFO, which is getting further down that track, and so hopefully we can close that out in the next couple of months, and the additional NED appointment that I mentioned earlier. So some good developments, good progress, and really I suppose that's it for the first 4 months. You know, let's hope that the headwinds improve a little bit. So I think that's the end of my presentation. So I think we're over to questions now.
Chris, that's great, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while Chris takes a few moments to review those questions submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Chris, as you can see, we've received a number of questions from investors throughout today's presentation, and may I take the chance to thank all the investors for submitting their questions. If I could please just hand back to you to run through that Q&A tab, and where appropriate to do so, if you could please just read out the question and give your response, and then I'll pick up from you at the end. Thank you.
Yeah, no problem. So the first question is looking at are there any lessons that we can learn from Headlam's past where we've seen market softness and how the business has reacted, and what we could do perhaps to mitigate that. Of course, we have looked at that, and probably the last, we've had a couple of examples of that, unfortunately, in recent times, with Brexit and going back to the 2008 sort of change in demand pattern, if you like, and of course, COVID. There are some similarities, I suppose, particularly in the 2008 figure, and we saw demand just drop off and then come back up again. I suppose the market dynamics are slightly different now. You know, we have got a high degree of employment, so the market dynamics are a little bit different, and perhaps a little bit more positive in the medium term than maybe they were then. However, I think for me, this isn't about us just doing more of what we did in the past. Clearly, there's going to be an impact on all of the customer segments, but the strategy that we're looking to develop of moving into new customer segments where we've got no share to defend and no share to worry about, this is all new stuff, I think is the right thing to mitigate the softness that will undoubtedly happen in the next sort of 6 months or so. There's a question around supply chain, and I did briefly mention that. I think the supply chain is moved away from shortages of supply more into price inflation. So I think the scarcity of supply perhaps drove a little bit of price inflation earlier on in the cycle. We then saw raw material prices increase partly as a result of that, and then we've moved more into sort of heat, power, oil driven inflation. So we took the view that we should be full and robust on our supply chain, secure orders, secure products. So our position on stock is good, and we've got good depth of stock. And indeed, of course, in an inflationary environment, having that protection of a deep stock hold is also helpful. So I think that's the supply, the impact on supply chain isn't so much around scarcity of supply. It's now moved through to and sort of inflationary pressures in the marketplace. Another question on M&A that. This question is a little difficult to answer. So M&A, I said that there's nothing, we haven't done anything in the last little while, and it's difficult to say whether that will be what the scale of that might be. I think what the point I was trying to make is there may well be something that comes on. Now, if it's very large, clearly we'll need to do something different around facilities anyway. But I just wanted us to have a bit of firepower up our sleeve should something opportunistic or strategic pop up that we could then execute on. So it was more just a case of not to try and put any shape around the scale of an M&A opportunity. It's more just to say that we need to have flexibility in the balance sheet to enable us to react should something come up. A question around how does our strategy differentiate Headlam from our competitors at attracting new customers, supplier accounts? I think this comes back to the strength of the proposition and our service. I think the thing that we stand for and sets us apart is the quality of our service, the reliability of our service, and depth of stock holding. So that's the thing that we bring to the party. We've then been able to, over recent times, sort of tailor that. That's a core fundamental service proposition. But I think for us to grow share and to take share, particularly in these new customer segments, we've got to be able to tailor that proposition so that the customers can see and align with that. So, there's no point in us trying to sell a regional distribution proposition to a Wix as a national retailer. We need a national proposition as Headlam or one of our national brands to sell that to them, because that's what they need. So I think the differentiation really is about the proposition and how we can tailor it specifically for that customer type and offer good quality service across the whole of that portfolio to make the customer happy. Okay, so the question here around how does our organisation, with its multiple number of businesses and independence from sort of local empowerment, if you like, how do we assure a consistent approach and coordination of delivery? So this is I think the way to answer that is we've come up with a multi-layer approach on this. So I think traditionally, that question is absolutely right. We had a regional customer base with a regional distribution presence. And I think that's okay, and that's fine. They can continue to serve regionally and continue to serve locally. I think where we are moving forward now is, as I said, we're offering some national service for national customers, and we're also offering a national service with regional and local deliveries, actually. So one of the benefits of us coordinating and aligning our distribution network is we can now take orders in one part of the country and deliver in others through our network of distribution. So that's meant that we can now unlock, in a way perhaps we haven't before, a more coordinated approach, and in some cases the local delivery for national ordering. So that's relatively new, and that's part of the proposition we're taking into the multiple retailers. So I think the question was aimed at sort of this local independence versus this sort of overarching Headlam view. And I think we can almost get the best of both worlds if we can allow local business to continue to serve locally, but join up when we need to offer a sort of national service to larger customers. A follow-on question around brand development. So when I mention brand development, am I talking about product brands or Headlam as a brand? And I think it's actually both in reality. You may have noticed that when we launched the Headlam app, it's called the Headlam app, and there isn't very much awareness of what Headlam stands for as a part of the trading business, if you like. So we are pushing and investing in our product brands, as I said earlier, and I think perhaps a little bit more subtly, we're also investing in Headlam from an awareness perspective. And as I said, we're going after some of these big national customers and these new customer segments as Headlam, and we're doing that because that's a national brand and something that they can align with. And some of these bigger customers also quite like working with a PLC or a big corporate, and we have to do that through the Headlam brand. So there will be a bit of strengthening of the awareness of what Headlam stands for. We know our customers are fully aware of Headlam being the sort of parent of lots of the regional distribution business. So I don't, that's not a concern. But I think it does mean that we should be investing in Headlam as a brand, certainly for certain customer types, and also in product brands as well. There's a question around what I think might happen on the level of digital penetration into our order numbers. So the question is, if we've seen that grow from 11 to 25 in the last couple of years, could it be 50% plus in 2025? That's a good question, and I don't know clearly. I think if you look at the growth plans that we've got and how we're trying to move the business forward, what we do know is the independent retailers and that sort of traditional part of the market is a little less embracing of this sort of move to a more digital way of ordering. So what we are seeing is the bigger customers, the larger customers, really they have to order via a digital process. They have to give us that electronic order link. So if you think our growth may be aimed more at the multiple retailers, the larger retailers, and to some extent the trade counters, we are trying to promote that sort of click and collect type service. I think it will continue to grow. We've targeted 30%. It will be great if we can get through that, particularly as we bring on stream these new customers with a sort of enhanced e-commerce proposition. Whether it will get to 50%, don't know. I think it depends on the blend on how these different customer segments move together. There's a question about European performance, and admittedly, we've been relatively quiet on the European business. I think the business has continued to perform well. It's probably done a little bit better than the UK. The business has, for different reasons in many respects. So the bounce back from COVID, if you like, has happened in the UK and the Netherlands and France in sort of equal way. But we were, for those who have followed the business for a while, we were about restoring and recovering the French business from a relatively weakened position in the last few years. So we've seen that recovery continue in France, and that's been doing well. And the Dutch business has been doing well in any event. So that sort of returned back to where it was. We're not quite seeing the same pattern of sort of softness and strength in commercial and residential as we are in the other European businesses. So they're doing well, and they remain sort of on tracks for the year's performance. There's a question around, will the acceleration of the trade counter rollout mean that your CapEx spend will be more than the 7 million this year? The answer to that is it depends on the timing. So there is a natural lag of getting permission from landlords, getting the building and the construction done. If you recall, some of this spend is done on our own sites. Some of this spend is done on new sites that we've yet to procure. So there's a bit of a mixed bag. In some respects, it might be quite good if it is more than 7 million, because it means we've got more trade counter footprint to hit the ground running for next year. I suspect it will blend out. I think we're trying to go harder and faster, and there'll no doubt be some sites that get delayed. So at the moment, I can't see that number is going to change, but it's certainly something that we'll keep under watch. And if it does indeed look like it might be different, clearly we'll provide some guidance accordingly. Just scrolling through. So a question about have we seen recently a mix change between hard and soft flooring and tiling? So there has been a sort of mega trend, if you like, in the UK to move towards harder flooring, certainly in the downstairs environments, and in the commercial space, a real mixture of floors. So wood, laminates and carpet tiles or carpets all in the same room, coming up against each other. It's quite different to what it's been in the past. I think that's continued, and that trend away from, say, broadland carpet type product towards certainly towards LVT and laminate and vinyl has continued. Ceramics isn't something that we've got a great presence in. It's around 10 to 15% of the UK distribution market. So that might be something that we do more of in the future. Currently, we don't do a huge amount of it. I think the growth in that market's been slightly stronger for the reasons I've just outlined. What we have seen is probably a faster growth in as I said, the other hard flooring surfaces like laminate, LVT, and we offer distribution services across all of those product ranges. So yeah, that mix has changed and continues to change towards hard flooring slightly. Last question, which I'm going to answer. So, do you have any long-term plans to move up the supply chain into manufacturing via a JV or similar? No is the short answer to that. So I think we see ourselves as distributors. We if anything, have got more consumer presence than in the vertical, if you like, than manufacturing. I think manufacturing isn't something that we would look to do. We work with manufacturers to access products and distribute them into the UK. So I don't think there's really any need for us to do a JV. You know, we've got close relationships. We typically are those customers for many of our suppliers. And for me, it's about building those supplier relationships and getting closer to them than necessarily stepping into their shoes and starting to manufacture. So I think if anything, perhaps getting closer to consumers through brand awareness and starting to get a real sort of interrelationship between consumers, so they are picking our products. You know, I want that, please, Mr. Retailer, is a way of almost ensuring the sale comes to us. So I think, if anything, we'll probably get closer to consumers that way rather than into manufacturing. So I think that's the end of the questions. Is there any?
Chris, that's great. Thank you very much indeed for taking the time to address as many questions as you can from investors today. And of course, if there are any further questions submitted today, we'll make these available to you immediately after the presentation has ended for your review. And ladies and gentlemen, we'll publish all those responses where it's appropriate to do so on the Investor Meet Company platform. Chris, perhaps for redirecting investors to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please ask you for a few closing comments to wrap up with, that'd be great.
Yeah, no, thanks for your time and joining the presentation today. I think, you know, slide 22, the summary, which happens to be on the screen, is probably my closing comment, really. You know, it's a difficult market. Who knows what's going to happen? I think the strategy that we're deploying is well set. We've had an okay start to the year, but the strategy looks well set, and let's see what the rest of the year brings. So positive feeling, and let's just see how it goes this year. So thanks for joining.
Thanks very much for that, Chris. That's great. And thank you very much indeed for taking the time to update investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Headlam Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session. So good afternoon to you all.